Welcome to the deep dive. Today we're plunging into a really fascinating area where finance, psychology, and some timeless wisdom all seem to meet.
Yeah, and it's all found in something you might not expect, right? An annual letter from an investment firm?
Exactly. Specifically, Giverny Capital's 2019 annual letter to its partners. And believe me, this isn't your typical dry financial report.
Not at all. It's more like a treasure trove of insights. Their unique philosophy, market takes, lessons learned. It's all in there.
So our mission today is to unpack this letter. We want to pull out the most important nuggets, maybe some surprising facts, and really give you a shortcut to understanding what drives long-term investment success.
And how that thoughtful, patient approach can really make a huge difference.
We'll get into their history, their performance, even their biggest mistakes. They're quite open about them. And, of course, the philosophy that guides it all.
It sounds like their history is really deeply connected to that philosophy.
It seems so.
Yeah.
Maybe you could start us off. Tell us a bit about how the firm got started and, who shaped their thinking.
Sure. It really highlights the human side of investing, doesn't it? Beyond just spreadsheets.
Mm-hmm.
So the founder actually started back in 1993, just managing a family portfolio.
Okay.
And he was really inspired by the greats Warren Buffett, Benjamin Graham, John Templeton, Philip Fisher, Peter Lynch, the icons.
You can definitely see traces of their thinking, especially that value and long-term ownership focus.
Absolutely. It's woven right through their approach.
So he's got this inspiration managing the family money.
Yeah.
How did Giverny Capital become, Giverny Capital?
Well, after about 5 years, the results were consistently solid. So Giverny Capital Inc. was officially set up in 1998.
Right.
And they were careful about building the team. Jean-Philippe Bouchard, JP, joined in 2002, became a partner, got involved in picking investments.
Okay.
Then in 2005, Nicolas Locuyer and Corinne Primo came aboard, also eventually becoming partners.
So a core team built over time.
Exactly. And they expanded, too. Opened a U.S. office in Princeton back in 2009, and then a new partnership started in Manhattan right around the start of 2020. It's been a gradual, thoughtful growth.
And that careful approach seems to extend to how they view their clients, right? This whole "we are partners" idea. What's that really about?
Yeah, that's fundamental for them.
Yeah.
The idea from day one was, we manage your portfolio exactly like the founder manages his own Roshan global portfolio.
Since 93.
Since 93, complete alignment. That's why they call clients partners. They're in the same boat, investing right alongside you.
That transparency must be a big part of these letters then, beyond just the numbers.
Oh, definitely. The numbers are there, sure, but they put even more emphasis on explaining their long-term philosophy.
So you understand the why.
Exactly. The process, the rationale. It's about treating partners how they'd want to be treated. Pretty refreshing, actually.
It really is. And speaking of unique touches, I noticed the artwork in the letter.
Oh, yeah, that's a tradition since 2004. They use pieces from their corporate art collection.
Mm-hmm.
For this 2019 letter, it was a 2013 painting, Ice Shelf, by Canadian artist Wanda Coupe.
Just a nice little detail. Adds some personality.
It does.
Okay, let's unpack the performance, because the numbers are quite impressive, and they really speak to that patient approach we mentioned.
You really do.
So 2019, the Roshan Global Portfolio returned 25.6%. The benchmark was 22.3%. So
Yeah.
nice outperformance, 3.3%.
And that's even with, what, about a 5% drag from the Canadian dollar?
Right, even with that currency headwind. But the long-term view is where it gets really compelling.
Definitely.
Since July 1st, 1993, so over 26 years, the portfolio has compounded at 15.4% annually.
Wow.
Versus 9.3% for their weighted benchmark. That's an annualized outperformance of 6.2%.
6.2% annually for 26 years. That's just, that's remarkable consistency. Very few managers pull that off.
And they're not exactly shy about their goals either. They state this long-term objective: maintain an annual return 5% higher than the benchmark.
Ambitious.
Very. They even quote Alexandre Dumas' Cupidor Impossibilium: to desire the impossible.
Huh. I like that. It's bold, but looking at the track record, maybe not that impossible for them.
It does make you wonder how they pull it off consistently.
Well, discipline is a big part, but let's look at the specific U.S. and Canadian portfolios. That gives some clues.
Okay.
The Roshan U.S. portfolio, 2019 return was 32.1%, just edging out the S&P 500's 31.5%, so 0.6% outperformance that year.
Modest for the year, but the long term.
Yes. Since 1993, it's returned 14.6% annualized versus the S&P 500's 9.9%.
Okay, so that's 4.8% annual added value over more than 2 decades. That's significant.
It really is a testament to their stock picking.
Although they do mention it's gotten tougher lately to beat the S&P 500, right? With giants like Apple and Amazon dominating, plus the rise of index funds.
Exactly. Market concentration makes active management challenging sometimes.
Right.
But then look at the Rochon Canada portfolio. That's a different story.
Okay.
In 2019, it returned 29.0%, the S&P TSX index, 22.9%.
So a big beat there. Over 6% outperformance.
Yep. And the long-term numbers are even more striking. Over 13 years, it's done 16.5% annualized, the index. 5.2%.
Wait, 16.5% versus 5.2%? That's an 11.2% annual added value?
11.2% annually for 13 years.
Wow. And that's a more concentrated portfolio, isn't it? Like 20 stocks?
Yeah, roughly 20 securities, making up about 14% of the global portfolio.
So it really shows that a focused but still prudent portfolio can dramatically outperform. Smart concentration.
Exactly. It lets their best ideas really shine through.
What's interesting is how they talk about the market itself, this sort of dual nature they point out.
Mm-hmm. They highlight 2018 versus 2019.
Right, 2018.
Yeah.
Profits were up, but the market went down.
And 2019, profits kind of stalled, but the market shot up.
It perfectly illustrates that short-term, well, irrationality maybe, unpredictability certainly.
Yeah, the market can be pretty moody in the short run, which is tough for investors.
So given that volatility, how do they square that with their long-term view? Believing prices eventually match value?
They fundamentally believe that over the long term, the market does reflect intrinsic value.
Okay.
If you pick good companies, sound businesses, and you're patient, the price eventually catches up to the reality of the business.
So focus on the business, not the ticker tape.
That's the core idea,
Right.
which leads to how they handle all the market noise, like, say, the U.S.-China trade disputes back in 2019.
Yeah, that was huge news. How did they approach it?
They state pretty clearly we don't predict macroeconomic stuff or political outcomes.
Right.
Their approach is all about selecting high-quality companies. Focus on what you can control, which businesses you own, not trying to time or predict things you can't.
That focus really comes through when they look back at the decade from 2010 to 2019.
Oh, yeah. What a turbulent time that was.
Occupy Wall Street, the U.S. bond downgrade, European crisis, Brexit, trade wars.
And they point out how many investors just sat on the sidelines, paralyzed by fear.
Yeah. And get this, they talk about ghost bear markets. These 20% drops in 2011 and 2018 that recovered quickly, so people kind of forgot them, but they were real drawdowns.
Right, moments of serious pain. But despite all that, the Rochon Global portfolio delivered an 18.2% annualized return during that decade.
18.2%. That's a total return of what, 433%?
Something like that. It just hammers home the massive opportunity cost of fear, of sitting out.
Absolutely. And they break down where those returns came from too, right?
Yeah, roughly 15% from actual corporate profit growth.
Okay. The underlying business is doing well.
Exactly. Then about 1% from PE ratios, expanding investors willing to pay a bit more for those earnings, and about 2.2% from the Canadian dollar depreciating against the US dollar.
So mostly driven by the companies themselves getting more profitable.
Precisely. It reinforces their core belief.
Oh.
Own great companies whose profits grow. That's the key.
Such a crucial point. It's so easy to get distracted by the fear.
Totally. And looking ahead, they were anticipating maybe weaker S&P 500 profit growth, maybe 5-6% for the next decade.
But for their own holdings.
They were still aiming for over 10% EPS growth from their portfolio companies.
So the message is, stay invested, focus on quality, ignore the headlines.
That's the gist. And this thinking applies to specific sectors, too, like energy.
Ah, yes, the energy revolution they talked about back in 2012. Shale gas, shale oil.
Right. And by 2019, the U.S. actually became a net oil exporter for the first time in decades. A huge shift.
But there was a paradox there, wasn't there?
Yeah, that's the fascinating part. U.S. oil production surged from maybe 6 million barrels a day in 2012 to nearly 13 million by 2019.
Huge increase.
But prices, they dropped from around $91 down to $52.
So more oil, lower prices. Tough decade for energy investors.
Very tough. It just shows how complex and unpredictable these things can be, even when production is booming.
And amidst all that, they noticed some good news that kind of flew under the radar.
Yeah, the quiet revolution. In 2019, renewable energy production in the U.S. actually exceeded coal for the first time.
Significant milestone. So how did Giverny position themselves in energy?
They largely avoided the traditional oil sector. They felt it lacked strong, durable, competitive advantages.
Okay.
Plus, they fundamentally believe humanity is shifting towards sustainable energy, so they actually own companies benefiting from things like electric car growth instead.
Interesting strategic choice.
Hmm.
Now, shifting gears a bit, they also talked about something really weird happening in the bond market back then.
Ah, yes. The aberration of negative yields.
Right. They called low-yield bonds, especially those negative ones in Europe, basically a guarantee of getting poorer, which makes sense.
Yeah, it's hard to argue with that. They use a wild example of the Austrian century bonds.
The 100-year bonds.
Yep. Issued in 2017 at 100 with a 2.1% coupon. Pretty low already.
Okay.
By 2019, just 2 years later, the price shot up to €210,
Doubled in price.
which pushed the yield to maturity down to a tiny 0.61%.
Crazy. That highlights the kind of irrationality, or maybe desperation, in the bond market then.
Absolutely. And globally, there was something like $17 trillion in negative yielding debt. They just called it an aberration, a distortion that couldn't last.
So, with all these market complexities, weird bond yields, unpredictable sectors, how does Giverny actually anchor themselves? How do they approach valuing companies?
Well, it starts with that mindset. They see themselves as owners of businesses, not just renters of stocks.
Right, not speculators.
Exactly. That's crucial. Then to measure value, they use owners' earnings.
Okay, inspired by Buffett, right?
Yeah.
How does that differ from regular earnings?
It tries to get closer to the real cash profits a business generates after reinvesting enough to maintain its position. Standard accounting earnings can be distorted sometimes.
By non-cash stuff, or how much they need to reinvest?
Right, so they estimate intrinsic value growth by looking at EPS growth plus the dividend yield. But they have this great philosophy guiding it.
Which is?
It is better to be roughly right than precisely wrong.
I love that. It acknowledges you can't pinpoint value exactly, but you need to be in the right ballpark. Focus on the economic engine.
Precisely. And the data they show is pretty compelling validation. Since 1996,
Okay.
their company's intrinsic value, measured this way, grew about 13.2% annually. And their stocks returned 13.3% annually over that same period.
Wow. So the stock returns almost perfectly tracked the underlying business value growth over the long run.
Exactly. It really shows the market does eventually recognize that fair value. It's not just theory. Their results bear it out.
And it explains their outperformance too, doesn't it?
It does. That 4.1% annual outperformance over the S&P 500 for 24 years, it tracks almost perfectly with their company's growing intrinsic value about 4.8% faster than the average S&P 500 company.
So it comes back to selecting better businesses and holding on. Simple, but not easy.
Definitely not easy. It requires patience, which interestingly, they also connect to a biography they read about Joseph Rosenfield, an investor Buffett admired. Rosenfield really emphasized patience, waiting for the right pitch.
That patience theme keeps coming up. But they also admit they aren't perfect. They have this section called the Podium of Errors.
Yeah, I found that incredibly transparent and brave, really.
What's the idea behind it? Just airing dirty laundry?
No, it's presented as a constructive thing, a Givernian tradition, they call it, a way to learn and get better.
Like a post-mortem.
Exactly. They do a systematic 5-year look back, 2014 was the example here. They look at successes, like buying Constellation software early that went up 500%, or getting out of PRA Group quickly when things went south.
Okay.
But they also highlight the mistakes, and they make a key point. Errors of omission, the great companies you didn't buy, are often way more costly than errors of commission, the ones you bought that went wrong.
Right, because the upside you miss can be huge.
Yeah.
So what landed on the podium for 2014?
Okay, so the bronze medal error was Microsoft.
Microsoft, really?
Yeah.
Yeah.
They sold it in 2011 for a modest gain. They completely missed the massive transformation under Satya Nadella, who took over in 2014.
Ah, the shift to cloud.
Exactly. The stock just exploded, multiplied 7-fold in 8 years. They watched that rocket ship take off from the sidelines. Ouch.
Yeah, that's got to sting. Okay, silver medal.
ResMed, the medical device company for sleep apnea. They'd owned it since 2003.
Okay.
They sold in early 2014. Why? They thought it looked too expensive, and earnings growth had slowed a bit.
But they knew the underlying story was still good.
That's the painful part. They admitted they knew sleep apnea was a huge, undertreated problem with great long-term growth prospects. But they sold anyway.
So what happened to the stock?
It went from $44 when they sold to $155 by the end of 2019.
Wow.
And since they first bought it around $8, if they'd just held on, it could have been a 20-bagger.
Oof. Peter Lynch's quote comes to mind, right?
Yeah.
Don't pull the flowers to water the weeds.
Exactly what they quoted. They pulled a flower too soon.
Okay, this is tough. What gets the gold medal? Or do you say platinum?
Yeah, they called this one potentially platinum. The error was Copart.
Copart. They auction wrecked cars online, right?
Yeah. A simple, strong business. Huge competitive advantages, great management. They loved the company.
So why did they buy it?
Valuation. Back in 2011, they thought it was too expensive. They kept waiting for a better price.
Even though they loved the business?
Even though they loved it. They even read a book about the founder in 2014. Still didn't buy.
Agonizing.
Totally. The stock went from around $11 to $80. And get this, in early 2016, it actually did pull back 25%, down to $16, trading at like 15 times earnings.
That was the chance, the long-awaited opportunity.
You'd think. But they still missed it. And the stock went on to return 8 times over the next 8.5 years from that initial point they considered it.
Wow. That's why it's platinum. Missing out on an 8x because you were waiting for perfect.
Exactly. A powerful lesson. Don't let the perfect be the enemy of the good, especially with a business you understand and admire.
These error reflections are so valuable. It really shows that investing is a continuous learning process, even for the best.
Absolutely. And it all circles back to what they call the ultimate wisdom. They draw heavily from Alexander Dumas here.
Right, the founder mentioned reading The Count of Monte Cristo.
Yeah, finding it full of economic insights and reflections on human nature. And he shared his favorite quote from the book, Father Faria speaking to Dantes.
What was the quote again?
To learn is not to know. There are the learners and the learned. Memory makes the one, philosophy the other. But how can someone learn philosophy? Philosophy cannot be taught. It is the application of the science to truth.
That's deep. And the parallel to investing is really strong, isn't it?
It really is. The difference between just knowing stuff, accumulating data, facts, and being truly wise.
Applying a philosophy, thinking critically, that love of wisdom, synthesizing, not just collecting.
Precisely. And that leads them to the final crucial ingredient.
Which is?
Patience. They argue that any investment philosophy, no matter how good, is useless without patience.
It's the essential human quality.
And they cap it off with another Dumas quote, this time from Queen Margot. To wait. All human wisdom is in this single word. The greatest, the strongest, the most skillful is he who knows how to wait.
To wait. Powerful stuff. It seems like that underpins everything they do.
It really does. They reiterate their belief in the quality of their companies, their commitment to being good stewards, focusing on strong balance sheets, dominant businesses.
And we can quickly summarize their core philosophy points for you, the listener, based on their appendix.
Yeah, basically, stocks are best long-term. Don't time the market. Returns follow value eventually.
Choose great companies, high margins, high ROE, great management, pay a realistic price.
See volatility as an opportunity, not a threat. And above all,
patience is paramount.
It's a very consistent, clear approach.
Definitely. So as we wrap up this deep dive into Giverny Capital's 2019 letter, it's just so clear that successful investing isn't only about the numbers or the models.
No, it's profoundly about human behavior, isn't it? Critical thinking, managing your own psychology, and that enduring power of patience.
Building a philosophy and having the discipline to stick with it.
We've seen how waiting, observing, focusing on real value, how that can turn a simple business or even a painful mistake into a huge lesson.
Yeah. So maybe a final thought for you listening. As you navigate all the information overload out there, how might embracing that love of wisdom, the application of science to truth, and mastering the art of waiting, how might that change your approach? Not just to investing maybe, but to learning and making decisions in any complex part of your life.
Something to think about.